interest rate setting mechanism in the United States is basically the Federal Reserve Bank in Washington, D.C. They set the short rates, but they're also setting long rates and medium-term rates when they get involved in things like quantitative easing, where they're buying back bonds and this artificially forcing rates lower. Now, this is great for people who borrow and speculate if your cost of money is cheap. And as long as they can borrow money cheaply and speculate with that money, and anytime they make a bad bet, the government bails them out for that bad bet. It's a no-lose situation for them. But that risk that is accumulated continues to accumulate. And since these corporations and banks don't want to account for the risk, they put it off balance sheet. They put it into special purpose entity accounts. They put it in the Cayman Islands. They put it outside of the system. But it's still out there building. The risk is building more and more. And this risk ultimately has to be borne by the general population, who will experience this risk exploding in their face, either through inflation or through higher taxes or through social upheaval. And this is because that risk has not been properly channeled in the system to give a more balanced system. So the way to avoid this would be to allow interest rates to really be set by the market and not by the Federal Reserve Bank. So interest rates, the price of money, would reflect the demand for money. So if there is a speculative bubble and there is a huge demand for money, then the cost of money would go up, and that would tend to temper the demand for money. It acts as a self-reinforcing mechanism within this thing called free market capitalism, which can work if it's given enough room to work. But these rates are being kept artificially low. And a lot of people think this is great for them because, well, their credit card and mortgages, they think, might be at a lower rate, even though that's not. Credit cards and mortgages are still grossly much higher than they would be related to the basic discount rate at the Federal Reserve Bank level. But they have this conception that lower rates are somehow good for them, but that's completely false. Higher rates are great for savers, workers and savers, because if you work and you make some money, you want to put it in the bank and you want to get a rate of return. You want to get 5, 6, 7% on your money. If the economy is so great, why can't I get any savings, any return on my savings?